users?
Yeah, so UZEDY is a really interesting drug. So this is a treatment for schizophrenia. So maybe to add, there are 1.6 million Americans who suffer from schizophrenia. And so it's a big market. And the long-acting, this is an injectable, which we call the long-acting market, is worth about $4 billion. Now, what we have with this product is what we call a very patient and physician-friendly. What we mean by that, when it comes to administering the product to a patient, it's just one injection, and then you get to the therapeutic dose within 24 hours. Our competitors have one injection, then they have to come back into the office, or they have to have supplementary oral therapy. And as you can imagine, when you're having a relapse, the physician wants to get you under control as quickly as possible, as does the patient. So what we've seen in the rollout is real excitement across the healthcare professionals. So the adoption and the purchasing from hospitals has been good. It's very early days still, so I don't want to sort of exclude that. We're only 5 weeks in. But the initial reaction from physicians is very positive, and as long as that continues and the hospitals have taken up our sampling opportunity, then I think this bodes well.
And Richard, one of the other big headlines from the earnings release was that Teva set aside $200 million for a possible settlement with the DOJ over that case about alleged price fixing. In this scenario, why are you considering settlement?
Well, this has been discussions that are going on for some time, and so we believe that we've come to a good agreement, and if we can close that agreement, it's important that we actually financially allocate that money there. So I think this has been a work in progress. I think when it comes to litigation, I think Teva has our litigation in our rearview mirror now. We're very much focused on our strategy of driving growth, and that's why, with that level of focus, we can achieve the results we achieved in Q2.
And we don't have much time left, but of course we're having this conversation against a backdrop of really record high drug shortages in the US. Of course, Teva is one of the biggest generic drug manufacturers. What needs to change so that these drugs can become more available?
Well, I think when it comes to Teva, we make a commitment to make sure that we can supply our drugs and make sure there's access to medicines across the board, and we've done that for many years. And what I would say is, people talk about drug shortages in generics, but when you look at innovative medicines as well, and when I go back to Austedo, the treatment that we had that grew 51%, there are 800,000 people suffering from tardive dyskinesia in America, and only 50,000 on treatment. So that's just another example of people getting access to the medicines they need, and that's both, in more commonly described medicines as well as some of these more innovative products as well.
Richard, really appreciate you taking time for us today. That's the CEO over at Teva Pharmaceuticals, Richard Francis. Stick with us, a lot more coverage coming up from New York. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets to close, almost 2:30 here in New York. Let's get a quick check of what's happening in the commodity space. Abigail Doolittle standing by right now with our commodities close.
Well, similar to stocks remain, we have a bit of a risk-off tone here for commodities. New York crude down 2.3%, despite the inventory number. Natural gas down 3.2%. Silver down 1.9%. Wheat down 1.8%. So really broad-based selling right across the board. The Bloomberg Commodity Index itself is down more than 1.5%, down for another day in a row. And I keep talking about how commodities drop when the dollar goes higher. If we go into the terminal, we can see this relationship. This is true, too, right now for stocks. So what we're looking at here, of course, is the Bloomberg Dollar Index up for a third day in a row. Over these 3 days, up more than 1%. Here is the Bloomberg Commodity Index. I think it's down for a second day in a row, not 3 days. But you can see as the dollar goes higher, what commodities, of course, are denominated in. The Bloomberg Commodity Index goes lower, Romaine. So very similar situation right now for stocks and commodities with this dollar higher, creating a risk-off sense.
All right, thanks there to Abigail. Let's stay in the commodity space, particularly in the energy and oil space. Our next guest is an expert in this area. Fred Zeidman joining us right now. He's the former CEO and chairman emeritus over at the Gordian Group and formerly a big oil executive as well. Look, you've got a long resume. You understand how this market works, Fred. You also just saw crude oil, what was it, $79.53 a barrel, $80 a barrel right now at a time where, I don't know, the Biden administration is trying to replenish the strategic petroleum reserve. The economy is trying to get on the right foot.
Well, no matter how long I've been in this business, I learn a lot every day, and this is a perfect example. I mean, here we are. We've got a strategic energy reserve, and the purpose of that is for disasters when there's production cuts, and all of a sudden we are in the United States where the politicians are weighing in. The Biden administration drained, I think, the biggest drawdown today that they've drawn in I don't remember how many years, and there's no reason for this other than political. They're trying to keep the price of oil suppressed at a time when, again, their policies have been to destroy the fossil fuel energy totally. They all started the day that he was elected and shut down the Keystone Pipeline. Right. And all the signals were there that this was going to happen, and now he's draining the strategic reserve to make that work. And Council for Secure America, which I co-chair with Harold Hamm, who I believe you said you're going to have on tomorrow. Our sole purpose is to try and explain to Americans what they're doing to themselves and doing to our country.
There's been a lot of discussions, though. I mean, you know, there are a lot of motivations as to why the SPR was drawn down. The Biden administration would tell you it was because of the war in Ukraine. But there was a broader discussion about national security, right? The idea that we couldn't just be reliant on foreign sources of oil, something that we address, not necessarily through government policy, but it was something we addressed as a nation. But the idea that we also needed some diversification to other energy sources as well.
Well, First of all,
Yeah.
you've got to remember when all of this, the war in Ukraine literally had nothing to do with this. This is all a result of an administration policy to do away with fossil fuel. Again, the shutdown of the pipelines, the extension of the permitting process, the shutting down of leasing of federal lands, all of these were to cut down production of American oil. And
just to stop you there, though, but they've said that explicitly. I mean, that's not exactly a secret. I mean, they've made it clear, not necessarily a shutdown of fossil fuels, but certainly less of a reliance.
Well, no, that's true.
Okay, yeah.
But that's a long-term project, number one.
Yeah.
Number two, any alternative fuel is still dependent on fossil fuel. I laughingly say, what are the windmills made out of? What are everything made of?
We're not supposed to think about that.
They're all made,
it's like electric
cars, out of plastic, right?
Oh, okay.
I live right by the Houston Ship Channel. I see this stuff coming and going all day long, right? And everybody wants to shut that down. How are they going to make windmills? If they, how are they going to make the solar panels? If in fact you don't have any plastic product to make that happen. So our energy independence, and obviously fracking and horizontal drilling had so much to do with that, made us independent geopolitically of foreign oil, where we were not at the whim, if you will, of the foreign producers who have lifting costs $8–10 a barrel. And can control the up and down prices at all. We became energy independent. We could continue to be energy independent if they would let us drill and if they would allow us to get the oil product and gas from the fields down to the refineries to produce. That's all it takes. It's a fairly simple answer, and it's become a totally geopolitical football, if you will. The reason, these are not economic reasons. The fact that oil is down today, $2 has nothing to do.
But do you see this being resolved? I mean, you mentioned the political football. I'm sure you know Washington has changed a lot over the last couple of decades, and just the ability for the two sides to agree on anything. So as long as you have a narrow majority, whether it's in the House or the Senate, I mean, what are the chances that you get any meaningful shift in policy?
Well, I hate to say it, but there's almost none. I mean, what we're experiencing right now in Washington, D.C., arguably, look, I was in my teens in the 60s, right? I was there for the Vietnam War. I mean, I remember the issues with a divisive America, but it's never been as divisive as it is right now. And it's divisive solely over political ideology and not what's good for the United States and not what's good for any of its citizens. We're paying major prices at the gas pump right now, and we're doing that again, and now we're draining the strategic reserve for the purpose of keeping gas prices down. Well, somebody better wake up one day and remember that we've got to replace all the oil that's in that reserve. We haven't seen our last hurricane. We arguably have not seen our last war. We've not seen our last flooding or disaster. So we're going to need that oil in the reserve. When are we going to put it up? Those prices are not going back unless, if you will, one of the foreign producers, like Russia and Saudi Arabia did once before, decided that they want to show us that they still have a dog in the hunt. And so what do? They drop prices to $20 a barrel. $20 a barrel. Saudi Arabia still made plenty of profit. So Russia found out they weren't so.
So Fred, I'm sorry to cut you off because we're up against a hard commercial break.
Sorry.
No, that's okay. Because I mean, on your point, we should point out that Bloomberg reported yesterday that the Biden administration, they got rebuffed on a lot of the bids that were coming in. Basically, I guess in their mind it was too low. So you have a market that's basically saying we're not going to play this game.
Exactly.
We need to get you back to talk a lot more, mainly about how kind of the trade routes have changed, dominance of China and everything. But we are up against a hard commercial.
Yeah,
really
Fred,
great to talk to you.
Really great to talk to you. Hope you can come back soon.
My pleasure. I would be happy to. Again, we've got a major chore in trying to inform America about what's really going on into the individual pocketbooks, which is hopefully what people So
Right.
Council for Secure America is going to continue to consume my time.
Yeah.
All right. Well, hope to check in with you soon. That is Fred Zeitman. He is Chairman Emeritus at the Gordian Group. And still ahead, Amazon. It's kicking off the biggest grocery reboot since acquiring Whole Foods. We'll have all the details next. This is Bloomberg.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced.
Group meeting. Special guest Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsbee, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street week you won't want to miss. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
All right, let's get right to our top calls. The big movers on the back of analyst recommendations. And we start off with Pinterest, an upgrade today to buy over at Rosenblatt, with the analyst saying Pinterest actually navigating the choppy ad market. Unfortunately, investors not quite buying it just yet. Those shares down 4% on the day. Next up, let's take a look at Bloomin' Brands, the owner of the Outback Steakhouse, getting cut to market perform. This over at William Blair. Analysts actually say this has a lot to do with their international exposure, particularly in Brazil, and tax legislation there that could actually affect earnings. Bloomin' down 2.5% on the day. And finally, Norwegian Cruise Line downgraded over at Susquehanna, going down to neutral. The analyst saying that the cruise line company is still in the early to middle innings of that turnaround plan. The shares, which tanked yesterday, down another 3.5% today. And those are some of our top calls. Let's stay in the sell side space right now and look ahead to earnings tomorrow after the bell. Amazon set to report. Michael Pachter joining us right now over at Wedbush to talk a little bit here about what he's expecting out of the company. And Michael, this is a very sprawling company at this point. I don't know if it's a consumer company, a web company, a grocery company, or a streaming service, or what. What are you expecting to hear tomorrow?
Oh, I think that all that investors should care about is whether we're going to see another quarter of kind of slow growth, and I think that's what we're going to get. They guided to growth of $6 billion at the high end this quarter on $127 billion base. So I think we kind of expect about the same this next quarter, about $6 billion, and you throw Prime Day in there, that adds about $4 or $5 billion. So they really should guide to that. I'm not sure they will. I think the economy's fine. I think that consumers are feeling more confident buying more stuff, but I think Amazon is extraordinarily cautious. I expect kind of a wimpy guide, and the stock has just ripped this year. You've seen it up over 30%. I think it probably takes a breather for a week or two. I think we get into next quarter and then things start to turn around and really, really improve for them. But they are, in fact, a consumer retailer.
Yeah.
They're really good at it. They use tech.
Well, let's talk a little bit more about the consumer side. We're showing some images right now of the latest reporting that we have about them sort of overhauling that grocery business. I mean, that merger, or that acquisition, I should say, of Whole Foods, it left a lot of people scratching their heads a few years ago when they did it. What is the strategy there right now on groceries?
I think the strategy initially came from Bezos, who's not particularly overly involved day to day. But back then, I think they were looking for refrigerated distribution centers. So I think that they bought Whole Foods at a time when they were failing, badly at Amazon Fresh, at home grocery delivery. They were trying to charge you an incremental, $15 a month for grocery delivery. When they got Whole Foods, the thought was they'd be able to deliver from the Whole Foods market. They actually never executed on that. They actually ended up building refrigerated distribution centers around the country just to make it easier for them to consolidate. And so now they're stuck with this grocery chain that brings in a good customer. It's probably 90 plus overlap with Prime customers, so really good synergies. And they kind of failed to exploit that. They went after Amazon Go and Amazon Fresh retail stores instead of branding them as Whole Foods Express, which everybody would have understood and recognized quality. So much like Musk at X, who is completely destroying a brand by ignoring it, I think Andy Jassy at Amazon is ignoring the Whole Foods brand and allowing it to wither. I think he could really do something with Whole Foods Express, and he's not exploiting that.
Michael, what's amazing is we're having this conversation about Amazon. I don't think I've heard you say artificial intelligence once, which is, of course, the buzzword around everything tech these days. How are you thinking about in Amazon and AI?
Yeah, I mean, I am artificial intelligence, so please discount me to say. Look, AI's been around forever. When you type a text and it recommends a word or it respells your word, that's AI. Amazon's been using that and machine learning forever. And, they're probably not ahead of everybody else. Microsoft's probably a bit ahead. Google might be a bit ahead. They're going to use that. And I think, they can exploit that in a number of ways. But probably cloud management is the biggest opportunity. And again, we're not going to see it. We're not going to understand it. People are really the new buzzword is generative AI, where you're creating a document. Amazon doesn't care about that. That is completely irrelevant to their business. It's really more understanding consumer behavior and what we're looking for next, and then pushing out an ad or an email to us to get us to make that purchase. And they're really good at it. They remember everything you've ever done, and they come after you and remind you to do it again and again. So I think that because of their relationship with the consumer, they and Google are probably in the best position to exploit AI because they touch consumers. Microsoft is a distant third with much better tech.
All right, Michael, always great to talk to you. Michael Pachter there, Managing Director for Equity Research over at Wedbush. A look ahead to Amazon earnings tomorrow after the bell. Coming up here in the Here and Now, key players in economic policy and business gathering in Colorado for the latest meeting of the Aspen Economic Strategy Group. Melissa Kearney, University of Maryland professor, and of course the lead group director of the Aspen Economic Strategy Group, going to be joining us in just a second. This is Bloomberg.
reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Time now for our Wall Street Week Daily segment. David Weston, the host of Wall Street Week, joins us every day at this time, but today he joins us from Aspen, where the Aspen Economic Strategy Group is underway. David's standing by right now with the lead of that group. David, take it away.
Thank you so much, Romain. Yes, we have come all the way to Aspen, Colorado to attend the annual meeting of the Aspen Economic Strategy Group, and we're delighted to start off with the executive director. She is Professor Melissa Carney. She's Professor of Economics at Maryland. So, Melissa, thank you so much for having us here. It's great to be with you in person.
It's great to be with you, David.
So let's start with the most basic thing. What do you hope to accomplish? If this goes beautifully this week, what will we get out of it?
Sure. So I hope that our group, and we're a really diverse group of people with different perspectives and experiences, I hope that we can come together and have robust, honest, off-the-record conversations about some of the really pressing economic challenges facing our nation. And at the end of the meeting, our hope is that we uncover evidence-based, bipartisan solutions that the country can implement going forward.
And your theme this year specifically is building a resilient U.S. economy.
Building a more resilient U.S. economy.
Boy, it's in the news right now.
Yes.
With the Fitch downgrading the ratings, with hearing we're going to have to borrow more money out of the Treasury. I'm not saying you're going to fix everything from this, but how can you differentiate what you're doing from so much discussion about things like taxes and about deficits and about debt?
Well, one thing that makes us really unique and I think is really important to our whole endeavor is that we are a truly bipartisan group. So we are explicitly sort of, half people with Democratic-leaning inclinations and half more right-leaning inclinations, people from the business sector, academic community, policy sector, community leaders. And so I'm hoping that, we come together, we're not in our echo chambers, we talk about actionable things, nothing's dead on arrival because you've got people with different political persuasions, different inclinations in the room, part of the conversations.
Now, the work is going on even as we're speaking, as I understand.
Right.
There will be papers ultimately coming out of this that will be published.
Yes, so we have a bunch of papers that are briefing materials for our meeting. So we, again, part of the point is so that we all have the right data and evidence in front of us. So we could talk about the need for tax policy reform, for getting our fiscal house in order, for investing more in a skilled workforce. We're all looking at the same data and evidence, and then these papers will be published and released publicly in the fall.
And you have economic experts, obviously, also business leaders here. I mean, you're co-chaired, as I understand it, by Hank Paulson, Tim Geithner, two former Treasury secretaries. You've got Larry Summers here. You also got Brian Moynihan from Bank of America, and some Fed governors.
Yeah, that's right. We have a lot of both current and former economic policy leaders, real leaders in the business community, some of the best academics working on these challenges. And so, I'd like to think we have some of the key best minds tackling together these challenges. And the other thing I would say about our group is people are really committed and everyone has the same ultimate goal in mind, which is building a really strong U.S. economy that delivers prosperity in a widespread way.
So you're running the whole thing, but you're a little bit of a player coach because you're also doing your own work in economics, specifically focusing on how we're spending federal funds for young people as opposed to some of the more senior people like me. Take us through that. I mean, we all think we may be spending too much money, but it's also where we're spending the money.
Yeah, so
So, part of building a more resilient U.S. economy is really investing in our future workforce. Of course, that's something business leaders really need to take seriously, right? So how do we build up a productive, highly skilled workforce for the next generation? And one of the points that, I make with my co-author in the paper that we've put together for this meeting is that we are, as a country, vastly underinvesting in children. So just when you look at the federal budget numbers, you see that we spend 5 times as much on an annual per capita basis on Americans over the age of 65 as under 18. So we're spending $29,000 a year on people over age 65 compared to $5,600 for kids under 18. And that just doesn't make any sense, right? So, normatively, I'd like to think we value children as much as the elderly in this country and did more to take care of them and invest in them. But even setting for kids under 18, and that just doesn't make any sense, right? So, normatively, I'd like to think we value children as much as the elderly in this country and did more to take care of them and invest in them. But even setting that aside and just want to be cold-hearted economists about this, we are not putting our money into our future generation. We have lots of evidence that the social returns to investing in kids is high. A lot of these programs actually save the government money in the long run. And again, why should a group like this and business leaders really care about this? We're leaving human capital potential undeveloped.
And you put your finger on something that seems key to me, which is it's not just how much we're spending, but the return on investment. To come back to business terms.
Yeah.
Because the return on investment for, again, old people like me is negative, if anything, as I understand it, as opposed to kids.
And I'm not saying we should renege on our promise to take care of the elderly in this country, but, there are kids where we know when we spend more money on them, they do better in school, they have better health, and ultimately they make more money as adults, pay more in taxes, rely on government programs less. So the net cost in the long term to the government from spending on things like youth education and nutrition is actually negative. So there's a huge social return. And it's sort of insane that we're not putting more money into those programs that we know have this really positive social return. And again, from a business perspective, build up our future working population.
So Wall Street Week out here all week long. Thanks to you. Thank you very much. We'll be talking with people who are doing this work. But give us a sense looking forward to the fall. What is the result of this? Talk to us about the papers. When will we see them? How will we see them?
Yeah, great. So, we have these papers that we're putting together. Our group will be discussing, and then the authors will go back and incorporate the input and feedback they get from this very diverse group with different perspectives. And then we'll be publicly releasing all these papers in a volume in the fall, probably late November. And then, we're hoping to push forward the conversation in Washington, D.C., in the business community, and really surface these actionable ideas.
Well, we really look forward to the entire week and then the aftermath after that. Thank you so much. That's Melissa Carney. She's the Executive Director of the Aspen Economic Strategy Group. Romaine?
All right, our thanks there to David Weston out there in Colorado. We'll check in with him again soon, I'm sure, and be sure to check out Wall Street Week, which airs every Friday at 6 p.m. Eastern Time. Meanwhile, back here on this Wednesday afternoon, a look at the broader markets here. Right across the screen here, a lot of this, of course, has to do with the increase that we're seeing in yields, at least on the longer end of the curve. You're looking at a 30-year yield, slightly higher here on the day by about 7 basis points. Your 10-year yield right now up about 5, but across the board in equities right now, Katie Greifeld, we're looking at declines. The S&P 500 right now setting up for its worst day since April.
And you have to wonder how much of that is based off what we're seeing in yields versus what we saw in ADP this morning, another signal that this labor market remains hot.
Yeah, we kind of forget a big jobs report scheduled for this Friday amid all the hullabaloo over the Fitch downgrade. A conversation about that coming up.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Hi, everyone. Madison Mills here with Jess Metton. We are lucky to be filling in for Carol Masser and Tim Stenivek because they are both off today. And what a day for them to be off.
I know.
Because stocks, Jess, they're puking.
And I'm surprised they let us co-host again. We always have so much fun, but what a day to do this. And especially if you look at the S&P 500, it hasn't had a 1% down day since May. So it tells you how long it's gone with that streak. So this would be the first time we've seen that, but obviously you're seeing more tech corners, growth corners of the market selling off.
Yeah, I think it's been like 48 days
since
we've seen that over 1% decline. So as Jess was mentioning, yeah, a lot of red on the screen here following those moves from the Treasury Department, right? We've got corporate earnings, a hotter than expected ADP report, and the U.S. credit rating, right, Jess?
So that's another big thing. But then also looking at these moves in the bond market, especially when you have that happening with this Treasury issuance, also you're looking at the 10-year Treasury yield above 4%. So then you're going to have to recalibrate, see some moves in these more tech growth-oriented markets, especially when you think of the Magnificent Seven, all down today. Apple not quite as much as the other ones, but obviously those weightings going to weigh on the stock market, Maddie.
Yeah, I'm going to run through some of the headlines that we're going to talk about in the show while we make sure that you have an IFB for our simulcast, Jess, because right around the same time as that credit downgrade that we got last night, former President Trump was indicted. We're going to talk about what to expect and his upcoming court meeting in D.C. there. And also, let's not forget, amidst all this news, we're in the middle of earnings season, and we've got the two big tech names coming up this week that could turn this market around, especially given the red that we're seeing on the screen today. Of course, I'm talking about Apple and Amazon coming up on Thursday. And then we're going to go over to the magazine here because we're wondering if Amazon could become the biggest grocer in the U.S. If Paul Sweeney were here, he'd be talking about how currently that title is held by the one and only Walmart, never forget. And then, of course, we're going to talk about family farming. In the U.S., it's struggling right now. We're going to talk to the COO of True Story Foods about what is next for the industry. So that's what we've got coming up on our show today. Having said that, I do want to do a quick check on the markets here. The S&P 500 down by 1.25%. The NASDAQ down by almost 2%. The Dow Jones Industrial Average doing a little bit better because it's not as heavily weighted to the tech side as those other names I just went through, down by about 0.9% here. We're going to head over to our team on the close. See you there.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld, joined right now by our colleagues in our radio booth, Madison Mills and Jess Menton, in for Carol Masser and Tim Stenivek. Welcome to our audiences across all of our Bloomberg platforms, originals, radio, and of course right here on television. Guys, interesting moves in the market today.
Yeah, Romaine, no pressure on Apple and Amazon coming in later this week. It just feels like the entire market is relying on those names to reverse the puking that we're seeing today, as Katie Greifeld would say.
Thank you for watching.
Yeah.
You're welcome. You're welcome.
And then also just looking at the S&P 500, I mean, it hasn't seen a down day of more than 1% since May. So it tells you how long that streak's been going on, but obviously looking at what's happening
It's only
with
down
tech
1%. Is that puking? It's more like just retching or something.
Puking, retching, pick your poison there. But guys, I do want to talk about the story that we are focusing on in our radio booth today. I know we're talking a lot about the debt of the U.S., but what about the debt of student loan borrowers right now? Because payments starting back up in October, we've got a growing chorus of borrowers saying that they're going to ignore the end of that pause. They're not going to pay back their student loans.
Can you do that?
Bold.
Well, the question on their minds is this student debt going to get forgiven eventually? And also, some of them feel like they don't have a choice because inflation is so high right now, Jess.
Definitely, and especially just anecdotally going through and looking at some of these examples. Some of them, for instance, maybe they had already gone to college, but then they took out another loan for their master's programs, over $100,000. And then once they graduated, they didn't get the type of salary that they were hoping to pay back these types of loans. Some of them having more hourly type wages and really struggling there,
Yeah.
as well as with what's been happening, even though we have seen inflation come down a bit, still
Well,
struggling.
there was a
with
great
some of those
Business Week
costs.
cover story just on that issue, and they were quoting all these people with master's degrees and PhDs about how they're paying it off. And the most intriguing thing about that story was all these people with master's degrees and PhDs seem to be working at Starbucks and restaurants and other areas that I don't think they went to get a master's or PhD for.
It's grim. It's a grim backdrop. We'll see how that actually...
Can you just not pay your bills, though? Because I believe the U.S. government tried that, or thought they
Hopefully
were
we
gonna try
check
that.
back in with some of the voices in the story, because I am interested to see how that goes. But let's talk about the debt of the U.S., because, of course, the big story today is Fitch downgrading the U.S., taking away its top-tier rating. That leaves a pretty rarefied class of countries that still have all 3 AAA ratings. I'm looking at a Bloomberg story right now. I believe there's 9, and that includes Germany, Denmark, the Netherlands, Sweden, Norway, Switzerland, Luxembourg, Singapore, and Australia.
Australia? Wow,
Australia.
Look at Australia.
Not Canada.
Yeah.
Not Canada. It has 2 AAA ratings, but not the 3rd.
Yeah, I mean, look, let's get to the broader issue, and we've been having this conversation, like, how much does this matter? I mean, we know that, just like when you talk about an FX, it's always a pairs trade. It's all relative, right? And you could say to a certain degree, at least when it comes to the U.S. and its sovereign debt, what you're going to buy. Are you going to go into AA plus U.S., or are you going to go into AAA Luxembourg?
Yeah, but
I mean, no offense to Luxembourg.
Yeah.
I'm sure it's a beautiful country. I've never set foot in
If
it.
they're watching.
I mean, I think you can walk the whole country like in an hour, right?
Well, Romaine, you got to get on the consumer spending train that Jess and I have been on with our Barbie tickets and book a trip to Luxembourg there.
That has gone twice.
I've been to Switzerland.
I saw
Switzerland's nice.
Jess at the theater the
saw
second
each
time
other.
I saw you
Norway.
guys. So
Wow.
you
I thought
two
Norway's
really
just
missed
oil,
out.
right?
Yeah.
What a well-traveled simulcast.
And Sweden is just fish. What's in the Netherlands? I always get the
no one
Netherlands
knows.
confused.
No one knows.
Right.
Well,
Yeah.
no fiscal deficit though, right,
Yeah.
guys? Fiscal deficit 6.7% here in the U.S., 0% for them. So I'll leave it on that incredible data point
Where's
for
Holland?
you guys. We are going to be back
What's their
together
rating? That's what I want to know.
again, Romaine, where we can talk way more about your travels to Luxembourg at 4 p.m. for our Beyond the Bell coverage when we take you through the day's close. And a reminder, Bloomberg Business Week is now on Bloomberg Originals. Sussing out the market moves today, because obviously this Fitch downgrade is a huge move, but it seems like the Treasury Department is the real driver on the day, because when it comes to that Fitch downgrading, it feels like traders don't really care, economists doubting the credibility of the move. So here to make sense of the day's trade for us is Elena Papina from Bloomberg's equities team and our chief economist, Anna Won, joining us from DC. Elena, I want to start with you. Thank you so much for coming on. It's great to have you here. From the perspective of the market's reaction, would you say the Fitch rating is kind of a non-event today?
It was a non-event yesterday after the bell when the decision broke and the futures were on the SPY ETF were down about 0.1%. So it wasn't a big reaction. Then today, earlier today, when we got the announcement about the Treasury Department increasing the auction size, that's when the decision actually became a much bigger impact on the stock market. So we are now down more than 1% on the S&P 500. Not an unusual move, but it is getting some investors worried about whether there is more to come.
I want to bring Anna into this conversation because do you think that this move was actually warranted by Fitch?
Yeah, so I think the substance of it was, which is the fiscal trajectory of the U.S. Government balance sheet, is warranted because part of it is that, just 3 weeks ago, the U.S. Treasury released the year-to-date picture of fiscal deficit. And actually, it surprised many people by how weak it looked. In fact, the deficit for 2023 is expected to be much larger than last year, partly because of weaker receipts. So that was, I think, one perhaps one piece of information that Fitch was waiting after the debt ceiling was resolved in thinking, should we downgrade or not? So because this year, fiscal deficit for U.S. is expected to surge to 5.7%. And then on the longer term, the fiscal picture also doesn't look good. We forecast that 2033 fiscal deficit, the debt to GDP ratio would be over 130% of GDP. So yeah, on that grounds, I think the decision was warranted.
Well, Anna, I want to stick with you for a second because we are obviously seeing some comparisons to 12 years ago. Today, a lot of people saying that it's a completely different situation. Can you tell me exactly, in your view, how different the backdrop is today versus what we saw with the S&P rating downgrade in 2011?
Well, first of all, I would say that my view is different than the predominant view of the market, that ultimately the market will shrug it off, this downgrade. I do think there's a risk that ultimately the market won't shrug it off and we'll be having a repeat of 2011. So I think most people think that it's different than 2011 because back then we still have the European debt sovereign debt crisis, and today we have not. Well, today we still have a weakening global economic backdrop. Germany is looking like they're in recession. China is fueling hard landing scares. And U.S. also is actually not as strong as many people think. That's reason number one. Number two is, and right now, when we look at the U.S., various asset market like VIX, equities market, there's just this sort of complacency, and people have been ignoring the negative data surprises in the last couple of months, and I feel like people are kind of just so in love with the soft landing narrative that I think markets are actually due for some kind of correction. So in that sense, I think we're pretty vulnerable at this stage.
So Elena, with that said, and looking at the NASDAQ 100 up, 40% this year, and then the S&P 500 also up double digits, is it an excuse to take some profits?
It actually can be. A lot of traders have been telling me that there hasn't been a catalyst to sell. We did know that position became overextended. It was time for a breather, and now comes the catalyst. Now the bigger question is it going to be a 5% correction? Is it going to be just a buy the dip situation with stocks rallying tomorrow and into the weekend? So that is the big unknown. And I want to talk about earnings because earnings have been a big supporter to the S&P 500 rally over the first quarter and early over the second quarter results. We do expect to see Apple and Amazon reporting tomorrow, so that can be a potential catalyst. If they do report disappointing earnings that trail expectations, so that could be a catalyst for a much bigger and potentially more prolonged sell-off.
What does positioning tell us at this point as far as who could potentially be selling? If we're talking about hedge funds, is it too early to really tell that versus retail investors?
That's a great question, but we don't know yet. We do know that retail investors have been buying into last week. So last week was the first one when they were net sellers of equities. Whether that's a smart move, considering today's rout, is yet to be seen. But yeah, they kind of pared back their appetite after jumping in earlier in May and earlier in June. So if hedge funds decide to become big sellers, that may be an interesting story for sure.
And Anna, bringing you back in here, I'm curious about how you're viewing the move from Fitch from an economics perspective, because as you noted, we're hearing a lot of pushback today. Jamie Dimon coming out against the move as well. Does this hurt their credibility, and does that matter?
Well, I think Fitch is kind of bringing reality back to everybody. I think, of course, from Jamie Dimon's perspective, a market rally is great for JP Morgan, right? But I think, as I was saying before, the market has been complacent in recent weeks because of this, prevalence of the soft landing narrative. And on the eve of every recession in the past, half a century, the soft landing narrative tends to dominate too. Yeah. And Fitch sorts of put the focus back on these ugly fiscal numbers. And I thought that one of the most interesting things that the Fitch downgrade caused us to notice is that these the Treasury data showing the receipts and deficit that was released a couple of weeks ago, it shows that receipts was weaker then is weakening. And usually, before a recession, receipts would weaken, and it's always the case. And I think it does confirm our suspicion that maybe a lot of the activity data is overstating the strength in the economy.
Something I'm curious about, Anna, is whether or not, when you're thinking about more market-moving type rating agencies, whether it's Moody's or S&P, do you think we'd actually see downgrades like that from them?
Well, S&P already downgraded back in 2011, and they never re-upgraded the U.S. So right now, 2 of 3 major rating agencies have taken away the U.S. The stellar rating. So it's just down to Moody's now.
Yeah, and on that, I guess, Elena, I want to ask you kind of what Anna was saying earlier. Anna mentioned that you think that the market slugging off this downgrade is not going to be the case in the coming weeks. Do you agree? Do you think that the market is going to start to have a more prolonged reaction to this?
It's interesting that August and September are traditionally, seasonally, the weakest months of the year, going back the past 30 years. So there may be a reason for a bigger sell-off just because of a confluence of factors, right? Fitch obviously was a big surprise for a lot of traders, thinking that we're going to go to the moon. It's not the case, and the positioning looks extended on several fronts, and seasonality isn't, adding confidence into the stock market trajectory in the next couple of weeks. So there might be some choppiness in the next, 3 to 4 weeks, or maybe a couple of months even.
Something I'm curious about, Anna, is whether or not this is a wake-up call for Congress.
Yeah, I think the debt ceiling fight back in June was a missed opportunity for both sides to address the real fiscal challenges, which is Social Security, healthcare, right? I mean, 20 years ago when Al Gore, was it 20 years ago? Yeah, 20 years ago when Al Gore was debating George Bush, they were talking about reforming Social Security and lockbox. Now we don't hear that anymore in this presidential debate. I think those issues need to get back on the table, and I think when 2 of 3 major ratings agencies have downgraded the U.S., it certainly is a wake-up call.
What's the likelihood of this actually being a wake-up call, though, in our next 20 seconds, Anna?
I don't think, I'm not optimistic that it will truly be a wake-up call.
Wouldn't it be great if the big market-moving, headline-breaking news was, in fact, a wake-up call for action?
Right.
Anna, thank you.
Not.
Thank you so much for joining us. Anna Won, our chief economist, joining us from D.C. And Elena Popena, thank you so much. It was great to have you in studio with us to talk about this from the equities perspective. Again, still seeing that red on the screen, the NASDAQ down by 2.24%, S&P down by 1.4%, and the Dow Jones winning the day, only down by 1%. Stick with us here on Bloomberg Business Week Radio. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yes, 3:21 on Wall Street. We do check markets all day long here at Bloomberg. Very close to session lows right now with a 63-point drop for the S&P 500 index. We are at 4514, a decline today of 1.4%. The Dow down 340 points now. That is a drop of almost 1%. NASDAQ is down 311 points. The composite index down now by 2.2%. 10-year yield 4.07% with that 2-year at 4.88%. Spot gold down $8.50 the ounce to $19.35, drop there of 0.4%. And West Texas Intermediate crude 79.85 a barrel, down 1.9%. Stocks are falling, bond yields are rising following hot jobs data, and as the Treasury said it will ramp up its debt issuance only a day after the U.S. was downgraded by Fitch Ratings. As for the market backdrop, Lori Calvasina is head of U.S. equity strategy at RBC Capital Markets.
If you look at how the market's been acting since that October low, we're starting to see signs of small caps doing a little bit better. We're starting to see signs of lower quality, smaller cap stocks doing a little bit better, even within the Russell 1000. This market is acting like we're in a recovery trade, like we already had a recession, like we priced it in, and that we're pricing in that recovery now.
And speaking of small caps, the Russell 2000 down 1.3%. By the way, you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Sources tell Bloomberg American Airlines is in talks with Airbus and Boeing to order at least 100 narrow-body jets to replace some of the oldest aircraft in its fleet. Apple and Goldman Sachs say their new high-yield savings account has reached $10 billion in deposits, showing strength in the face of speculations that the partners may be heading for a breakup. After the bell, Qualcomm and PayPal. I'm Charlie Pellet. It's a Bloomberg Business Flash.
All right. Thank you so much, Charlie. Well, former President Trump, he's got another meeting in Washington at federal court, expected to face charges that he conspired to obstruct the 2020 election. This, of course, is the case brought by special counsel Jack Smith. So here to discuss the latest developments, we've got Bloomberg anchor and Washington correspondent Kaylee Lines with us from D.C., and Bloomberg White House reporter Gregory Cordy on the line as well. Kaylee, I want to start with you because this is your third round of indictments you've covered for the former president. How similar is this going to be in terms of what it's going to look like for next steps here?
Well, in terms of the actual arraignment process, it will look fairly similar. As you said, Trump does have a date at the court, the federal court here in D.C. tomorrow. That is scheduled for 4 p.m. Eastern time. And in terms of process, it's going to look like a lot of other people who have been criminally charged. He's going to get his fingerprint digitally taken, though this time around he won't have a mugshot taken because he is identifiable as the former president and already has had photos of him taken before. He will not, though, be arrested. Of course, in New York, it was historic in that first indictment, a state indictment. It was the first time we'd ever seen not only a former president indicted, but also arrested in that case. That won't happen this time around, but it still is going to be a massive day in history as this former president is facing 4 counts of trying to interfere with the usual peaceful transition of power here in the U.S. democracy.
Gregory, I want to bring you into this conversation. Walk us through the latest details in this indictment and put it in context with the others in the backdrop of this.
Third indictment, the first was in Manhattan. That was the hush money case where he is alleged to have paid a pornographic actress to shut her up before the 2016 election. The Manhattan DA is bringing that case. The second case was in South Florida. That's what we call the documents case. He continued to retain classified material after he was president when he no longer had the right to do so, and kept it in a sort of an unsecure environment at his mansion in Mar-a-Lago. And now this is the third case. This is comes out of the January 6th investigation. It is the most wide-ranging of the cases. And it alleges that Trump was part of a conspiracy to overturn the results of the 2020 election by a number of means, and one of which is to get fake electors to show up at state capitals to cast votes for Trump when those states in fact voted for Joe Biden, and that he on January 6th itself, pressured Mike Pence to either delay or overturn or use some sort of mechanism to have that would end up as him becoming reelected as president instead of Joe Biden. And now, by the way, there's a fourth case that we're all sort of waiting for that fourth shoe to drop in Fulton County, Georgia, where a prosecutor in Atlanta is investigating whether Trump criminally pressured state officials there to change the outcome of the 2020 election in Georgia.
Right, and this is the former president who is also current presidential candidate. So, Kaylee, I'm curious about the political implications here for the former president. Does this case have any bearing on his polling numbers in comparison with some of the other cases?
Well, we're going to have to wait and see, as this indictment is less than 24 hours old, ultimately what happens in the polls. But what we have seen in the prior two indictments is that this actually works in the president's favor, that he sees a tick up in his polling numbers. He becomes even more so the front runner, as we saw in the previous two indictments. What also will be really telling, though, is what donations he is able to pull in off the back of this. Of course, we saw him raise millions of dollars off the back of that first indictment in New York. The effect was less substantial the second time when he was indicted federally in that documents case. And what we know is that he is spending a lot of money on legal fees. Both the president's campaign and the super PACs that are supporting him have spent something like $40 million on legal bills for not just the former president, but his associates as well. So as we're talking about these three cases, and as Gregory was just talking about a potential fourth case, it's also going to be about A, can he pay for it? Can he keep raking in donations to do so? But then also it literally just becomes a question of his calendar. How can he also be campaigning when he's going to be on trial for a lot of 2024? In New York, he's scheduled to be on trial in March of next year, and then in Florida in May of next year. And we're still waiting for the trial date in this case, but it's going to be very difficult to accomplish all of these things at the same time, running an active campaign while also fighting all of these different legal challenges.
Gregory, what's the timetable for how long each of these could potentially last? And is there any way for Trump to have a plea deal in some of these different trials?
Yeah, it's hard to know until we get to a potential trial, but these are complicated cases and could take at least 2-3 weeks, I would think. A judge would have to perhaps accommodate Trump's schedule. There are some of these trials already are scheduled during a busy primary season, as Kaylee was just talking about. There will be debates. There will be other campaign events. All of these are trials, the criminal trials. Trump is also the subject. He's a defendant in a number of civil trials where he does not have to appear. But these are criminal trials where Trump will have to be there. And it'll be interesting to see how accommodating each of the judges are to his political calendar and how willing they are to work around that. But so far, the prosecution in all these cases seems to be taking their speedy trial obligation seriously and urging the judges to schedule these well before the November election.
Yeah, I think it was such a great point that you made, Kaylee, about how the former president is going to balance all of these trial dates with his campaign calendar. When you think about the politics side here, I do want to get your take, Kaylee, on the credit downgrading of the U.S. and how that is going to be played both by the Trump campaign and the Biden campaign. What do we know so far about how each camp is responding to that?
Well, we've already heard from the Biden administration in response to that downgrade, pointing to the fact that Fitch had previously warned about how essentially what happened in 2020 and questions around the integrity of the election plays into this. It's that governance aspect of the downgrade, that this isn't just about the fiscal picture in the United States, about the debt load and our high debt to GDP ratio, that it also literally is about the way our government is functioning on the one hand. On the other hand, though, of course, when we talk about fiscal responsibility, it often is a Republican talking point that the U.S. is spending too much money, that we need to cut our spending. This really was the heart of the debt ceiling deal that was struck, was Republicans wanting to make sure that we were spending less. But clearly that deal being struck earlier this year was not enough to prevent Fitch from doing this. So it's kind of a pick your poison, different ways that different camps can play the downgrade, though it does seem to be largely agreed upon at this point in Washington and among the economics community that this downgrade is pretty surprising and the timing is questionable.
Gregory, would Trump be able to potentially pardon himself for some of the federal charges, maybe not the state ones?
Yeah, we're moving into unprecedented legal territory here, and that is still an open question. The argument for it is that the presidential pardon power is actually one of the most absolute powers that any president has. There are very few restrictions on it. He doesn't have to get approval from Congress. He doesn't have to get approval from the courts. He doesn't even have to take the advice of his own Justice Department or the Office of the Pardon Attorney, which usually sifts through these cases. The argument against it that some legal scholars have brought up is a more historic one in terms of where it comes from in common law and how kings in the monarchies used to wield it, but also that the Constitution says that the president shall grant pardons and pardons and reprieves, and by granting, that means you're giving it to someone else. You can't give it to yourself. It's very much an open question, and we're moving into uncharted territory, as we have been through this whole process. We've never had a president or a former president or a presidential candidate of his stature arrested and indicted once, much less 3 times.
Yeah, it's definitely historic and continues to be both surprising and unsurprising. Gregory Cordy, thank you so much for joining us from the D.C. Bureau, and thank you so much to Bloomberg anchor and Washington correspondent Kayleigh Lyons for joining us as well. We know you guys are very busy covering all of the developments here, so we really appreciate it. And Jess, I do want to quickly do another quick look at the markets with you because we're still seeing lots of red on the screen as we head into the close.
We are, and especially when you're looking at what's happening in the technology and communication services sectors. Those are the ones leading the S&P 500 lower. Not surprisingly, when you're thinking about some of these magnificent 7 names, all of them down. Some of them not quite as much, say Apple, but you do have NVIDIA also down sharply, so those weightings weighing on the S&P 500.
Yeah, it's a great reminder that the earnings that we're going to get from the likes of Apple and Amazon on Thursday are going to be really critical to watch. Let's get a check on world and national news now with Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Hey, Madison. The U.S. Capitol is in lockdown, and Capitol Police say they're searching a Senate office building after receiving a disturbing 911 call. There are reports it concerns a possible active shooter. Police are asking people on Capitol Hill to shelter in place. The House and the Senate are both on their August break, but congressional staffers are still working in the Capitol complex. Well, security was already being beefed up in Washington, with former President Trump appearing tomorrow for his arraignment on 4 new criminal charges in connection with his alleged attempts to overturn the results from the 2020 presidential election. Despite the new charges, Bloomberg's Jonathan Tamari says Trump supporters appear to be holding firm.
The more they see him be charged, the more Republican voters seem to think that he's being persecuted unfairly, and they kind of rally to his side, at least to this point. We'll see. His former Vice President Mike Pence actually had some pretty strong criticism of him after this latest indictment. So I think we'll see if other candidates are able to turn this against Trump. So far, it's worked for him in the primary.
Again, that's Bloomberg's Jonathan Tamari. An aide says New Jersey Governor Phil Murphy is cutting short his Italy vacation and will return to the state tomorrow after the death of Lieutenant Governor Sheila Oliver. She died this week from an undisclosed medical condition. And the Mega Millions lottery jackpot is heading even higher. We get the latest from Bloomberg's Michael Barr.
For the 30th straight time, no one has matched all the numbers. Friday's jackpot is now estimated at $1.25 billion. Some people are ready to quit their jobs and make money for it. However, this woman is in the why bother camp.
The odds are so against us in what, maybe centuries, decades? No one has won here. No one. So I'm not buying into it.
In New York, Michael Barr, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We've got just about 20 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ 100 index, Russell 2000 as well, all very much in the red. In fact, we are very close to session lows. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks plunging from the start today after that U.S. credit downgrade by Fitch. Dow's currently down 380 points. S&P's dropped 67, and NASDAQ is lower by 320 points. The U.S. 10-year yield at 4.07%. Gold is down 9. Oil trading in the red, and Bitcoin is little changed. Among the main 11 S&P sectors, only consumer staples and utilities were in the green. Tech and telecom were under pressure. And leaders to the upside in the Dow, Walgreens and Coca-Cola, while Intel fell 4% and led to the downside. Also after earnings, Generac plunged 24%, Paycom fell 19%, and SolarEdge dropped 18%. In other news, a WWE filing disclosed a federal subpoena served on Vince McMahon. And wrapping things up, some of the names reporting after the bell tonight include Clorox, McKesson, Qualcomm, and PayPal. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. We're going to be busy, and to hear live breaking news over your Bloomberg, type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Jess Smitten in Madison Mills here in the Bloomberg Interactive Brokers Studio on a day where you're looking at the S&P 500 on pace for its worst day in a few months here. And who better to come in and chat with us as we only have a little less than 20 minutes before the closing bell than Nancy Pryl, who's co-chief executive officer and senior portfolio manager as Essex Investment Management on Zoom from Chicago. Nancy, thank you so much for joining Maddie and myself on what a day in the markets here. And I want to start off with just what's your view when it comes to the broader stock market reaction on the heels of obviously a confluence of a lot of events when you have, say, this Fitch downgrade, but you're also seeing a lot of activity with these treasury issuance in the bond market that obviously has made some big moves there in bond yields.
Well, we think that this move is really the pause that we needed. If you think about where we've come from this year, in the beginning of the year, almost everybody was very bearish, still worried about inflation, worried about an imminent recession, or maybe a not so imminent recession, but a recession nonetheless. And as the market's gone on, as we've gotten excited about generative AI, as we've gotten excited about the big cap, stalwart tech companies, complacency has started to build. And we've seen recently a crumbling of many of the bears who have been pivoting to bullish sentiment. We've seen massive short covering by hedge funds. We've seen money flowing into the market, both from institutions, but very importantly from individuals. And that's led us to a little bit of an overbought position where even though the earnings have been very good, in fact, better than expected, and even though the economy is proving to be resilient, expectations were just a little ahead of themselves. We think that the Fitch downgrade was the trigger that gave people who are getting a little bit cautious about this complacency the excuse to do a little bit of selling. But we think this is still very orderly and it's nothing more than a mid-course correction.
Is today kind of the perfect example of why we need to continue to worry about narrowness in a rally, specifically speaking about the Magnificent Seven kind of bringing up markets so strongly when you have a day where bonds might be weighing on those big tech names?
Yeah, well, I mean, I would say today the weakness is weighing on almost everything. It's a pretty broad-based sell-off, hitting both large cap, small cap, growth, value, et cetera. However, you're making a really good point, which is with a market that has been led by such a small sector of the market, and particularly by such a small number of names, that it's important not to overinvest in those well-recognized growth areas only, but to have a more diversified portfolio and to look where the strength is emerging. And what we have seen over the last couple of months is that the market is broadening. That strength is broadening, more sectors are participating, and really importantly, more market caps are participating. We've seen some strength building in those small and mid-cap areas that we had not seen earlier in the year. Those are still very attractively valued, particularly compared to their larger cap peers.
So how are you positioning then? Did you make any changes today with your portfolio positioning?
Well, we are not short-term traders. We are long-term investors. So although we do have some open orders, as we almost always do, it's not really driven by today's action per se. What we have been doing, though, and we've been doing this all year, is focusing on those areas that we believe will drive economic growth and drive that growth in a way that's better than expected, not just this year, but really over the next couple of years. To us, that means a big focus on industrials, on reshoring of manufacturing, reindustrialization of the United States and the world, infrastructure spending, the transition in energy and of the economy to a more electrified economy. So really building exposure in those areas and taking selective profits in those companies and those areas that maybe have gotten a little ahead of themselves. So taking our profits on stocks that are up 50, 60, 80% year to date.
What's your thinking then on which of those stocks you need to stay in for a second half of your rally versus the ones that you feel comfortable getting out of?
We think that the second half of the year will be led more down market cap. And we think it will be led more by companies, I would categorize them as GARP companies, growth at a reasonable price, rather than deep value companies. We think that the economy is likely to stay sluggish, but hopefully positive. We think, what we've been saying all year, and we're not changing our tune here, is that it's going to be a bumpy landing. So at times it may feel like we're going into a mild recession. At times it may feel like we're not, but that means you don't want to go deep value, but you want to focus on those areas where they have tailwinds on economic growth. To us, that means areas like environmental sustainability. So the companies that are doing traditional environmental management, you can think about landfills, you can think about incinerators, you can think about waste cleanup. We also want to focus on this transition to this electric economy. We want to think about the companies that are laying the groundwork for generative AI. Now, we all know about NVIDIA, but there are a lot of other companies that are below the radar screen that are also benefiting from the build out of these data centers. We, again, want to think about the reshoring of manufacturers, maybe semiconductor manufacturing equipment, factory automation equipment, those kinds of names that are selling at multiples that are less than 20 times, with earnings that are coming in better than expected, and revenue growth rates where they're seeing unit growth and not just pricing growth.
We still have about a little under 2 months before the Fed's next rate decision, but we do have Jackson Hole at the end of this month. What's your view on the Fed's rate hiking cycle, and do you think they are done?
Well, I think they are, in fact, data dependent. It doesn't feel like that all the time, but I thought from Chair Powell's last comments when he spoke, what was it, a week ago or maybe a week and a half ago, and he talked about the fact that they need to recognize the direction of inflation and not wait until we reach the target. And that's really the first time I've heard him say that, certainly at least in a long time. So what he said explicitly was that they will need to pause before we get to 2%. They will need to cut before we get to 2%. We just need to see clear indications, clear evidence that we're on the way there. Our best guess is that they won't actually say very much at Jackson Hole, that they will keep things somewhat close to the vest, waiting to see the data that comes out between now and September. The data so far has indicated that inflation will continue to moderate, and therefore they could continue to pause. My one hesitation there is that we are seeing some increases in oil. and in food, driven mostly by what's going on in Ukraine and Russia on the food side with wheat. And that might muddy the waters a little bit in the short run. So we could see one more 25
All right,
basis point
Nancy, thanks so much for joining us. Nancy Pryl, co-CEO and Senior Portfolio Manager at ASIC Investment Management, giving her perspective here on the markets on a big down day here. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. We are awaiting the latest quarterly numbers out of both Qualcomm and PayPal. Qualcomm shares, they're down ahead of earnings by 1.6%. PayPal, ahead of its report, down now by just about 2.9%. Advanced Micro Devices shares are tumbling 6.7% following earnings yesterday. Last night, the chipmaker reported better than expected second quarter results. But with more on the quarter and today's stock decline, here's Bloomberg's Ed Ludlow.
They said that the market opportunity for their AI offering, which is an AI accelerator GPU or a GPU-CPU hybrid, is $150 billion by 2027. AMD said that in the quarter gone, customer engagement with their AI products grew 7x. But I think there's a sense that engagement does not mean tangible sales. It's still a future opportunity.
Bloomberg's Ed Ludlow. And again, AMD shares down now by just about 6.7%. With today's decline, the stock is now up 69.2% in the year-to-date column. Starbucks shares, they're perking up as its quarterly sales fell short of analyst estimates. Sign momentum may be slowing for the coffee giant, but Starbucks shares advancing now by 1.1%. Pinterest shares lower after the social networking company failed to meet heightened expectations. Shares of Pinterest down now by 4%. And those are some of the company stories that we are following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, Madison Mills and Jess Metton here in for Carol Masser and Tim Stenovec, taking some much-deserved relaxation time today. Jess, I am very excited to get your take on this story because I have a strong feeling that you know more about capital rules than I do.
Look, this story on the terminal. So trading pool for college students sued by SEC over capital rules. So taking a look at this, so a brokerage run by former London Stock Exchange executive was sued by the SEC for these, quote, repeated violations on net capital requirements here. So seeing, especially when you're thinking about what's going on in this particular space, but also bringing in this trading pool when it comes to college students, right? And some of these issues here. So taking a look at this, though, I mean, not a ton of details on this front, but especially when you're looking at some of these net capital rules, it looks like as far as in this SEC responding to this, they talked about how this is supposed to be designed to ensure that broker-dealers have adequate liquid assets to meet their obligations to their customers and creditors. Not surprisingly, that they would have a comment like that. But I mean, it is one of those things that are a bit tricky here when you look at this particular corner of the market.
Yeah, you got to be careful when something sounds like it's a little bit too good to be true. Remember that it could, in fact, be illegal. That's always
definitely
important.
is. And you have to be careful, especially when it comes to the SEC, because they do not mess around.
They don't play around. I'm so interested. This story that we've got doesn't go into the details here, but I'm fascinated about this kind of alternative platform for trading, day trading rather, being marketed specifically to college students. It was called Ustock Trade LLC. I'm so curious about which college students got duped by this and what the Venn diagram is of those students and like liquidity followers.
I covered so much when it came to personal finance in the height of the pandemic, when it came to day trading and everyone who was stuck at home getting all into that during COVID and that kind of dynamic, and people who were thinking, hey, we're going to quit our jobs and we're going to go, be a day trader. Then a lot of them ended up getting burned last year, unfortunately, when we went to the bear market. Because everything seemed, especially in the beginning of 2021, you think about GameStop, AMC.
Oh, yeah.
Dogecoin.
All of
some
it.
Of these,
oh
my goodness, look at what has happened since then.
Yeah, absolutely. Okay, well, I got a lot of fun questions for you on that in our next break. But for now, we are going to head over to our TV simulcast because Bloomberg's Beyond the Bell. It starts right now. This is Bloomberg.
Where everyone gets spooked and then it all kind of comes back to fruition the next day. Stick with us. We are moving closer to the closing bell. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to the closing bell. And here they'll take us beyond the bell. It's a global simulcast with Madison Mills and Jess Metton. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership for those folks streaming on YouTube. Madison, markets right now pretty much where we left them, I think, the last time we spoke to you and Jess, which is down across the board.
Yeah, and it's really interesting to think about whether we are seeing some profit taking today, which I was able to read about from my incredible colleague Jess Metton's reporting earlier today. But one of the questions I have is how much of a rotation into that thinking are we going to see, and when is it going to stop? When is the buck going to stop when it comes to some traders taking some profits here, Jess?
Right, and a lot of my sources talking about some of the seasonality factors as well as positioning coming into August and maybe having an excuse to sell. But nonetheless, when you're looking at a lot of these big tech and growth names at the top of the S&P 500 and NASDAQ 100, which are obviously more heavily weighted, weighing on the stock. But I just want to say, I mean, Apple's only down around 1.5% 1.5%. I mean, still more than 1%. But when you think about some of these other big names, it's still not quite as violent of a sell-off that you would think it would be.
And well, you do the benchmark math, and you think about how much that 1% loss on Apple means for the overall index, and you end up with a day like today.
Yeah, I mean, in fact, it's not even just Apple. It's that whole Magnificent Seven, if you remember, that we always talk about.
Who named
Apple.
NVIDIA?
I don't know. Now, someone who apparently doesn't have that much creativity. But yeah, NVIDIA's down 5%. Amazon, Meta, Microsoft, Tesla, and Alphabet each down about 2% or so here. You put that all together, and well, you get a down day. You get a 2% down day for the NASDAQ composite. More than 300-point decline here as we get the closing bells in New York. The S&P 500, where that Magnificent Seven also has an outsized influence, down 63 points, or about 1.4%. The Dow Jones Industrial Average finishing the day down by 1, and the Russell 2000 lower on the day by about 1.4%. A lot of earnings to cover here after the closing bells, and we start with that right now. Qualcomm crossing the wire here. Their fiscal 3Q numbers coming in. Adjusted EPS, a beat, $1.87 versus street estimates of $1.81. Their revenue for the quarter also a slight beat as well, 8.44, excuse me. Their revenue for the quarter looks like a miss, 8.44 billion. The street was on average looking for 8.5. This is for the fiscal third quarter. Let's get you the guidance going forward for the fiscal fourth quarter. They're looking at revenue in a range of 8.1 to 8.9 billion. The street on average was looking for 8.8 billion. As for adjusted EPS for the fiscal fourth quarter, they're looking at a range of $1.80 to $2 a share. The street guys was looking for $1.94 on average.
Yeah, the CEO saying that as AI use cases proliferate to the edge, on-device AI has the potential to drive an inflection point across all of their products. Also saying they plan to proactively implement additional cost actions and still seeing calendar 2023 handset units down as well, Katie.
And it's interesting. This is one of those chip makers that hasn't really joined in with the euphoria that we've seen in some of the other names. Qualcomm only up about 17.6% for the year through today's close. It looks like after hours not really getting much of a lift after these numbers.
Definitely, and especially when you're thinking about the chip space and the Philadelphia Semiconductor Index this year rebounding close to around 40% after losing more than a third of its value last year, and seeing maybe the brunt of the pain that a lot of these chip makers had to go through over the past year might be past, which is something that Barclays had called earlier this year, but still, nonetheless, it's very tied to the trajectory of the economy.
It'll be interesting, too. We're going to get a nice cross read on the economy today with a lot of earnings after the bell, including Clorox, MGM, Occidental Petroleum, DoorDash, PayPal, Zillow, TripAdvisor, and as well as Etsy as well. And so you put that all together based on what we've seen so far during this earnings season, an earnings season that we've seen a lot of beats, but not by a significant amount. And investors still focus on the forward-looking guidance that continues to come in a bit soft.
And of course, we will break those earnings as we get them. As we wait, let's take a look at some of the sector performance that we saw today on a pretty miserable day for the S&P 500. You had 8, or rather 2 sectors in the green, the rest of the market in the red. You take a look at what managed to close in positive territory. It was consumer staples. It was healthcare. That screams pretty defensive to me. You take a look at the bottom. It was all your big tech names. If you look at the point contribution there, it was Microsoft, NVIDIA, Apple, and AMD leading that sector down lower.
All right, and I do want to get to some of the gainers here, but we are getting TripAdvisor earnings in. You guys seen second quarter adjusted EBITDA coming in at 90 million, the estimate being 92.3 there. Katie, do you want to go to Robinhood?
Let's go to Robinhood because we are getting some numbers there. Second quarter assets under custody actually rose $89 billion for the second quarter. The estimate there was for a hair below 83. Second quarter EPS coming in at 3 cents. And here's the redhead. The second quarter net revenue coming in at $486 million. The estimate there was for $472 million. You can see that's lifting shares. It's going to be really important when we get the monthly users because we had been expecting declines there. We're going to continue to follow this story, but right now it looks like shares rising.
Looking at amongst the biggest decliners here, looking at Generac, it's a generator manufacturer, ticker symbol GNRC, losing almost 25%, so its biggest decline since October of last year, and it reported adjusted earnings per share for the second quarter that did miss those analyst estimates. And then also AMD, we did hear from their earnings after the bell yesterday. And overall, it did actually top those second quarter estimates, but unfortunately reverse course when you saw this more broader sell-off, especially in chip stocks, so falling about 7%, so its worst day since actually May 3rd. And then another one is SolarEdge, so it's a solar equipment maker. Looking at that ticker symbol SEDG, that's down 18% at the close, so its worst loss actually just since basically, if you're looking at this, actually a year ago. So it was actually August 3rd of last year when it did lose 19%. So if you're looking at brokers like Cohen, for instance, is actually one of them that ended up cutting its price target on the stock. And really what happened with that is just, if you're looking at the revenue forecast, unfortunately just did not come in as strong as what analysts were anticipating. So really a lot of that is more tied to elevated inventories on that particular group. So those are amongst some of the bigger decliners that came in at the closing bell.
All right, I think DoorDash crossing the wire right now. If we care about that, we can just hit that real quickly here, guys. We're looking at revenue coming in the quarter, slightly above street estimates. Adjusted EBITDA also a beat as well here. The company, though, giving guidance here for the full year, and this is the kicker here, gross order value. They're giving a range of 64 to 65 billion, and that would be above street estimates, even at the low end of that range here. So there's been a lot of concerns here, not just about volume, but of course about margins for this business and whether that would hold up, at least based on the numbers that we're getting crossing the wire right now. That appears to be the case. So you see the knee-jerk reaction in the markets is to the downside.
Absolutely bouncing around here. It had popped higher. It had a lot of focus on this name after what we heard from Uber. Of course, Uber with its own food delivery business, and really a market of two, DoorDash and Uber. And it will be interesting to see what happens with DoorDash. But right now, shares decidedly lower.
There's a third option too, Katie. You
What's
can just
that?
go pick up your food yourself.
No, can't do that.
Well,
Absolutely
speaking
not.
of picking up your food, I also want to move over to the housing sector because Zillow reporting revenue for the second quarter that beat the average analyst estimate. Their revenue, 506 million. The estimate there was 472.9 million. Looking at Zillow in the trade here, up by about 3.8% in the close. Mortgages segment revenue hitting 24 million. The estimate being a touch more than that. Adjusted EBITDA coming in at 111 million. The estimate only 76.9 million. So a big beat there. And this comes after Zillow reported a partnership with Redfin that's going to help buyers and builders connect. So that led to a 52-week high on that name yesterday as well. And we're seeing more green on the screen for Zillow today, Jess.
And to put in some size and scope here, where we are at so far earnings season, about 65% of the S&P 500 by market cap have reported so far earnings have contracted around 8.4%, coming in with those preseason estimates from Bloomberg Intelligence, taking the consensus estimates on Wall Street, looking for a decline of about 9% there. So still a little bit better than as far as what was expected there, but not good. So that still is the worst decline there since that we've seen in a few years here.
All right, well, Zillow shares higher in after-hours trading. In fact, second biggest mover in after-hours trading. The biggest decliner in after-hours trading belongs to Etsy. Those earnings just crossed the wire a little while ago, and the 2Q numbers were a beat, at least on the revenue side and on adjusted EPS, but the guidance for the third quarter causing a little bit of concern. They're saying that gross merchandise sales for the third quarter will be in a range of 2.95 billion to about 3.1 billion, and revenue as a whole will come in at about 610 million to 645 million dollars. Now, the low end of that range would be a miss here, and that might be giving people some concern. The company also saying that EBITDA margins for the third quarter are going to be in a range of 27 to 28%.
Yeah, a big miss there for Etsy, Romaine. A drop in gross merchandise sales being a huge thing to watch when it comes to the trade and the earnings information, rather, that we're going to be getting in from them. Bloomberg Intelligence saying that they're going to want to talk to Etsy about management, hopefully providing more information about a new wedding registry feature that could help offset some of those merchandise sales there. Having said that, we are going to leave you guys to continue to cover the huge amount of redheads that we're getting across the screen on this earnings coverage here. That's going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, and of course YouTube. A reminder that Business Week is now on Bloomberg Originals, which you can find on YouTube. We're going to be back Apple and Amazon could be the heroes to turn this market around.
They really could when you think about these weightings that they have atop the S&P 500 and NASDAQ 100. So this could change after the bell on Thursday.
Yeah, we're going to have to see. We've got to wait a little bit longer to find that out. But we're going to get a little preview from two incredible guests. We've got Bloomberg Intelligence Senior U.S. Retail Analyst Poonam Goyal and Bloomberg Chief Technology Correspondent Mark Gurman joining us to give us a little preview of what's to come with the earnings picture here. Poonam, I want to start with you. What are you anticipating when it comes to the Amazon earnings picture heading into Thursday? Are we going to see anything surprising? Are we going to see a lot of green on the screen?
I think we're going to see good results when it comes to the marketplace. We think Prime Day and just growing online momentum should have helped their online sales with GMV and net revenues to really rise further than we had seen last year. What I think is going to really be the focus, though, is going to be AWS. And AWS sales are only expected to rise 9.5%. And the guidance, or, when they talk about the upcoming quarter, we think could be weaker. So even though we expect that, we think the longer term prospects for Amazon across its marketplace, advertising, AWS, all its businesses is still really promising. And I think that's what you've been seeing in the shares all year. They're up almost 50%. And it's really the fact that Amazon still has a long way to grow across all its businesses. And the near term hiccups in AWS are just temporary.
Want to bring Mark into this conversation. Also, Apple, ticker symbol AAPL for our radio listeners. That stock's also up about 50% this year, Mark. How much pressure is it on this company to deliver when you have these valuations so elevated here?
Yeah, I think the pressure is there because of the expectations, because of the valuation that's already there, and because of the pedestal they put themselves on, right? But we do know this is not going to be an incredible quarter for them. This is going to be the third revenue decline in a row, and they haven't had 3 annual revenue declines in a row in 7 years, since 2016. So not a great situation for them right now on an earnings perspective, but the numbers are still eye-melting. Right? Analysts believe it'll be coming around $82 billion for the quarter anyways.
What is the driver there, the catalyst that we're seeing that for a few quarters in a row now?
Yeah, I think it's a tough compare, right? I think 2022 was, pretty strong, particularly on the Mac, right? And I think that continued across 2022 after they switched from Intel to their own machines. And that created a material difference in their overall revenue, right? Mac sales really doubled across the year, and I think that's what created that gap there. And so going into the fourth quarter, they have a bit of an easier comp because you're going to have a stronger iPhone upgrade cycle this year because the supply chain issues they had at the tail end of 22, those have obviously been resolved for a while now.
Poonam, I want to go back to you on the retail space specifically with Amazon. Obviously, we know that Prime Day, huge boon for them, but we've been talking a little bit on the show recently about how Amazon can occasionally be where retailers go to die when they sort of make deals with Amazon. And I know you're not going to say something that stark there, but I am curious what their plan looks like to not have that narrative out there and whether we're going to get any intel on Amazon as a fashion retailer this earnings season.
Yeah, I think, look, at the end of the day, Amazon is where the eyeballs are, right? They have over 200 million Prime members, more than 160 million in the U.S. And while many would say that, when you get to Amazon, you're kind of penny pinched on the take rate being so high as it is, but retailers are still going there. Third-party merchants is where the growth is. If you look at 3P sales, once again, when they report tomorrow, they're going to be up in the teens, and that's well outpacing their own online revenue growth. In fact, if you look at just the mix of their GMV, 60% of it is from third-party sellers. So clearly that is an area of growth for them, and while many of them may complain about how tough it is to sell on Amazon, it's still where they want to be. It's where the consumers are, it's where the sales are. And while they sell on other marketplaces and even their own online outlets, Amazon is where they do get the bulk of their own revenues.
And Poonam, we know that cloud looms very large when it comes to Amazon and AWS, but what about AI? How much is it tied to that?
Yeah, I think AI is part of every company that I speak to today, including Amazon, and it is clearly a big focus, whether it's on retail or AWS. In fact, they've built their own team to really focus on generative AI. So we think that'll be a driver to increasing cloud momentum. Cloud's about over $80 billion in sales right now, with more than 23% profit margins. And in the longer run, that business can be a 30% plus margin business, which will add to Amazon's bottom line. Cloud has seen to generate the bulk of Amazon's profits. It was more than 100% of their profits just last year.
I want to go back to you, Mark. I almost just called you Apple. I'm so sorry.
I feel like they're so synonymous, though, right? When I think of Mark, I think of Apple.
Mark, you're so much more than the company that you cover, obviously. But I want to talk to you about Apple earnings. No. So I'm curious about the iPhone sales. Obviously, they've been sluggish, but wearables and accessories are expected to improve. Could we see the two cancel each other out?
Yeah, so the street is looking at about $8.4 billion in revenue coming from wearables, home, and accessories, and about $39.5 billion coming from iPhone sales. The iPhone sale would be a bit of a decline. Actually, that's for the third quarter, and then the wearables would be about a $400 million improvement, which makes sense given that last year they added the Apple Watch Ultra that raised average sales prices, ASPs, so you get that additional juice right there just from probably the more expensive model.
The current quarter, because we are looking ahead to September where they tend to roll out some of these new iPhones and other devices. What kind of insight potentially could we get from them on this earnings call? We only have about a minute left.
Yeah, I mean, they'll tell us whether or not it's going to be another annual revenue decline, or they'll tell us that they're expecting it probably directionally to go in the other direction. The street right now is expecting about $90.5 billion revenue for the current quarter, fourth quarter, which is a $400 million increase from $90.1 billion in the year ago, fourth quarter in 2022. So we'll see if the street was right, and I anticipate it'll probably lean in that growth direction given the easy comp that the iPhone 15 will have against the iPhone 14 from last year.
Poonam, what's your question on the earnings call for Amazon?
I want to know when AWS will improve. I mean, I think we're all looking to see if that momentum has gotten worse, which is what we expected, or when the turning point will be.
And Mark, what's your question on the call? We got 20 seconds left.
To be quite honest with you, they don't give me a question to ask on the call. But if I were able to ask a question, I would ask them how material they expect AI or AR/VR to eventually become.
That's ridiculous. They don't give you a question considering your name is literally Apple, according to me. Mark Gurman, thank you so much for joining us. Our, of course, chief technology correspondent. And of course, we had our senior U.S. retail analyst, Poonam Goyal from Bloomberg Intelligence, joining us to give us a preview of the Amazon and Apple earnings heading into Thursday of this week.
It seems like it's later in the week than
Like,
Thursday.
what day is
With
it
so
today?
many earnings,
I have no
it's hard
idea.
To keep track.
I guess it's Wednesday.
Wednesday still.
Oh, my goodness. You're listening to Bloomberg Business Week, guys. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long at Bloomberg. We are keeping an eye on PayPal shares after hours. That stock now tumbling 6.4%. Sifting through the report, PayPal did report total payment volume for the second quarter that managed to beat the average analyst estimate. But again, after hours, we've got PayPal shares tumbling by more than 6%. Also reporting, also closely watched after the close of trading, Qualcomm. It is the largest maker of smartphone processors, and it delivered a tepid revenue forecast for the current period, indicating the demand for mobile devices remains weak, even as the industry emerges from a glut. After hours, Qualcomm shares down now by 3.5%. Robinhood out with net revenue for the second quarter that did beat the average analyst estimate. A down day for stocks, with the Dow, the S&P, NASDAQ all finishing in the red, with the S&P down 63, a drop today of 1.4%. The Dow down 348 points, down by 1%. NASDAQ down 310. That was a drop of 2.2%. 10-year yield 4.06%, with a 2-year 4.86%. Spot gold down almost $9 the ounce to $19.35, drop there of 0.5%, while West Texas Intermediate crude end of the session below $80 a barrel at $79.76, a drop today of 2%. So again, recapping, PayPal, Qualcomm lower after hours, stocks lower across the board today, with the S&P down 63, a drop of 1.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton and Madison Mills here in the Bloomberg Interactive Brokers studio. And we've had so many different earnings come in after the closing bell. But another company that I was taking a close look at is this Canadian giant when it comes to Shopify. So did just report earnings, but heading into this, so this is ticker symbol SHOP, S-H-O-P, closed down 7% today. Worst day since February of 16th, earlier this year. But if you're looking at the latest earnings report, the revenue actually did beat estimates. But Shopify has been one of these companies that has been in this transitional period after divesting fulfillment of some of these assets, and then also cutting jobs earlier this year. And this has been a company that also was kind of leading the way when it came to some of these cost-cutting efforts, even before some of the bigger technology companies that we've talked about, say like the Metas of the world, which obviously when it comes to Facebook and the company for Meta, this went through these two big tranches of job cuts starting back at the end of late last year, but cutting around 20,000 jobs. But when it comes to Shopify, looking at this, its stock after hours down a little more than 2%, but a lot of these names kind of got swept up today, Maddie, when it came to this broader self. But Bloomberg Intelligence, Anurag Rana, who we all know very well, head of this earnings report from Shopify, he was talking about how he really did think that when it came to its adjusted gross margin, he was thinking it would rise modestly versus the first quarter, and a lot of that just due to the divestitures that we were talking about, and really because of its logistic business, as well as a recent restructuring that we've talked about. So a lot of these companies, when we think about cost-cutting efforts, and then also the margin story, because when we talk about big tech and growth stocks, Maddie, I think a lot of times we get so much hyped up around artificial intelligence because of NVIDIA in late May, but a lot of this for a lot of these companies, and even beyond tech and growth and some of these e-commerce type names, actually was more of a margin story coming into this year. Obviously so painful, but a lot of these companies were over hiring during the pandemic. Apple actually was an outlier and didn't do that as much as, say, Meta did. But when you think of Shopify, some of these other companies ended up having to go through these aggressive cost-cutting measures. That's something that's been a big key thing. So not just AI, but also margin. So Shopify, for instance, it's up close to 80% year to date.
Well, Jess, I just wanted to mention, because you were bringing up the AI picture, doing a quick word search as we like to do on AI. We have 3 mentions of AI in the first couple of paragraphs of the Shopify statement here. They mention Shopify Magic in their first business highlight in the earnings statement. It's a suite of AI-enabled features integrated across the Shopify platform, making it easier for merchants to run their businesses. There's also Sidekick. That's an AI-enabled commerce assistant. And then we've got a slew of other AI mentions here. But I always think about Shopify is what you're going to be interacting with if you are like a Skims shopper like me, the Kim Kardashian brand there, and something like an AI-enabled customer service and e-commerce assistant is really helpful for just getting down those kind of customer service interactions and the labor costs of that. But having said that, to your point, Jess, Shopify still having to cut those costs and becoming one of the kind of first big cost cutters in the space, and then still having to, compete with other marketplaces out there like the Amazons and eBays of the world.
It's true, and especially looking ahead, I know all eyes are going to be on what we were just talking about in one of our last segments, obviously, when it comes to Amazon and Apple after the closing bell tomorrow. But definitely when it comes to, it's funny because when you were talking about some of these other particular corners of the market in companies and different industries that talk about AI, we all like to harp back on last quarter when Kroger had 8 different mentions. So you even have companies that you aren't thinking about that are entering this, and it kind of makes you wonder, because in the late 1990s, especially with the rise of the internet, at that point Apple was struggling greatly, and fast forward to 2007, and that's when the iPhone came out. So there's a lot of players in the internet space that we didn't know at the time in the late 90s that ended up benefiting from it. So it makes me question a lot of the sources that I talk about. Obviously, we know about NVIDIA, Microsoft, some of these other names that are exposed to artificial intelligence. But what are some of the other players that we don't know yet that are really going to benefit from this?
Right. And, something that I've been thinking about this week is what players we're going to start to see becoming the big names in the social media space as well. After some of those earnings, we're seeing Snap continuing to struggle. I think they just had their fourth quarter of negative results when it comes to the earnings picture. Obviously, Pinterest down today after their earnings, and a lot of that is ad sales. We're seeing CMO budgets slashed this year. That's impacting the ad sale market for those social media companies. But when you think about user engagement and time spent on apps like Twitter, now X, and Facebook, now Meta, it's really gone down, and TikTok is taking up a lot of the kind of market share when it comes to eyeballs. So I'm curious to see what the earnings picture and what the big names of social media giants are going to start to look like in the years to come.
Especially, I did actually the Taking Stock column yesterday for our U.S. equities team. So I was taking a look at what's happening, because we talk about these tech and growth names, but then also what's been happening in the meme space. Tupperware was a big one yesterday that people were talking about. As far as that stock yesterday, at a certain point over the past 2 weeks, had been up over 800%. So you saw that stock trending on when it comes to stock twits and other avenues like that. And a lot of it, obviously, you're seeing more kind of like what we saw with Bed Bath & Beyond and sort of the frenzy around that in more of the retail space. So we've seen a lot of flows go into it, but that company has warned about potentially going bust pretty soon here. And it has a very small market cap still, less than $1 billion. But nonetheless, I'm looking at when it comes to ETF flows into U.S. listed ETFs. So there's around 2,200 of them. And there's been around actually more than $340 billion that have gone into them over the past year. But to put that into perspective, in the peak, in the height of everything in 2021 that we were talking about earlier, that was around $700 billion. So obviously, you're starting to see some movement there where investors are getting interested into memes again. But Christopher Kane over at Bloomberg Intelligence, when I was talking to him, he was chatting with me about how the euphoria, there isn't really euphoria yet. You're starting to see investors go back in, but to him, he feels like that's more of a sign that there has been more risk-taking. And he crunched the numbers, and historically, if you're looking at the Russell 1000, so that's another big large cap index, and typically a month out, 3 months, 6 months out, you'll still see that index higher when you see some of the similar movement that we've seen in some of these meme stocks. Obviously, they're very high risk, right? So that can get excessive, but to him, and then also Todd Sohn over at Strategic Securities was speaking about how he just didn't think the FOMO levels were at this sort of excessive euphoria just yet, but also mentioning that seasonality like we talked about today in the markets, right? September is actually the worst month of the year historically, but also August is right behind it. So if you do SCAG Go in the terminal, you can see a heat map and you can go back and see the average decline there. So it's one of those things where a lot of my sources kind of wondering here if some of the sell-off we've been seeing, if it's kind of an excuse, and then the positioning and just to sell as kind of, a lot of them were thinking thinking, hey, we might see, a 5%, 10% correction here after such a big move. But that remains to be seen. This could change dramatically after the bell tomorrow when you have Apple and Amazon, such big market cap weighted stocks, right?
Well, I'm so curious about so many things you just mentioned. I do want to mention that on our weekend show, we're going to have an interview with the CEO of Bed Bath & Beyond, formerly known as Overstock. And I asked him, how would you feel about this becoming another meme stock? And he said, no, we do not want this to become another meme stock. So it does sort of feel like if there's a risk on sentiment out there, kind of FOMO level that we're not reaching yet, but it's out there. I wonder if that's a sign that our economy is a little bit stronger than maybe we're anticipating. But I did want to ask you, Jess, about the kind of sell-off in August, and you said September being the worst month. I'm curious about why that is, because I thought summer was bad because people are all on vacation.
Well, sometimes people, especially July tends to be strong, but usually that's coming out of when people were booking in window dressing at the end of the second quarter. But the first half was so strong, a lot of people were doubting the July strength, but it was still there. So really it's more people, traders historically going on those final vacations before, obviously after the Labor Day holiday, trying to book those. But that's more if you talk to Jeff Hirsch over at the Stock Traders Almanac, he's always crunching the numbers there. So that's some of the dynamics that go into play. And then also there's just lower volatility, so then the moves can be bigger. But again, this is the first 1% down day we saw in the S&P 500 since right before Memorial Day. So really pretty listless this summer. Lack of big moves there.
No, it's such an interesting point. You never know, though, what's going to happen. You could get a U.S. credit downgrading or huge moves from the Treasury Department. So you got to always be kept on your toes when it comes to day trading. I'm glad that I just talk about it all day, and it's not my job to do it. We're going to shift gears a little bit because we're going to get a check on the latest world and national news with Nancy Lyons in D.C. Hey, Nance.
Hey, Madison. Washington is preparing for tomorrow's arraignment of former President Trump on 4 counts connected to his alleged efforts to overturn the 2020 presidential election. Bloomberg legal editor Sarah Forden has more on what we can expect.
He will show up at 4 p.m. tomorrow. He will be fingerprinted digitally. He will be giving his personal information. He will not have a mug shot taken because everybody knows what he looks like. We are expecting him to enter a plea. We are expecting him to plead not guilty.
Again, Bloomberg legal editor Sarah Forden. Whether Trump will receive a speedy trial is a big question, considering all the legal cases he's facing. John Lauro is representing the former president and spoke with Savannah Guthrie on the Today Show.
We're entitled to understand what the charges are. We're entitled to do our own investigation. The special counsel or the Justice Department, the Biden Justice Department, has had 3 years to investigate this. To take President Trump to trial in 90 days, of course, is absurd.
Lauro says he's absolutely sure they will win their case. Well, there were some scary moments this afternoon when the U.S. Capitol was put on lockdown after a concerning 911 phone call. Capitol Police say they have looked through all the buildings and have found nothing. A Pittsburgh jury is recommending the Tree of Life synagogue gunman be sentenced to death for the nation's deadliest attack on Jews. Robert Bowers killed 11 people after storming into the synagogue. U.S. Attorney Eric Olshan.
The evidence in this trial proved that the defendant acted because of white supremacist, anti-Semitic, and bigoted views that unfortunately are not original or unique to him. Sadly, they are too common.
Again, U.S. Attorney Eric Olshan. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 had its worst day since April, and after the bell, a ton of earnings reports, and most of them, the stocks are now trading lower. We begin with Zillow Group. It is down 6.5%. Zillow did report second quarter results that beat analyst estimates, but again, shares moving lower by 6.5%. PayPal up with earnings. It reported total payment volume for the second quarter that beat estimates, but after ours, PayPal shares down by 8%. And Qualcomm, the largest maker of smartphone processors, delivered a tepid revenue forecast for the current period, indicating the demand for mobile devices remains weak, even as the industry emerges from a glut. Well, as I mentioned, a down day for the Dow, the S&P, and NASDAQ, with the S&P down 63 today, down 1.4%. This year's $6.5 trillion rally in stocks hit a wall following hot jobs data and a ramp-up in Treasury issuance just a day after a U.S. credit downgrade by Fitch Ratings. The Dow down 348 points, down by 1%. NASDAQ down 310, a drop of 2.2%. 10-year yield 4.08%, with a 2-year yielding 4.88%. Spot gold down $9 the ounce to $19.35, down 0.5%. And crude holding below $80 a barrel. West Texas Intermediate crude $79.76 a barrel, down by 2%. Bottom line, a down day for the Dow, the S&P, and NASDAQ today. Worst day since April. Nancy Pryall is co-CEO and senior portfolio manager at Essex Investment Management, and she was our guest right here on Bloomberg Business Week.
We think that the Fitch downgrade was the trigger that gave people who are getting a little bit cautious about this complacency the excuse to do a little bit of selling. But we think this is still very orderly, and it's nothing more than a mid-course correction.
And again, down day on Wall Street, S&P falling 1.4%, and that is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton and Madison Mills here in the Bloomberg Interactive Broker Studio. And Maddie, I know how much you enjoy talking about the consumer, also the retail space, because we've talked so much about these big earnings coming up, especially with Amazon tomorrow. But we have another look as far as how retailers really struggled in the midst of COVID, and especially when it comes to the inventory issues. So who better to come in and chat with us about the startup space, but then also the retail outlook here as we head into close to the fall season, obviously toward the end of the year, the holiday shopping season, with Ari Trosdale, who's founder and chief executive officer of Crisp, who's here in studio with us. So it's always great having someone here. Thank you so much for coming into the Bloomberg office here in New York. Tell us first off about your company and what it is you do.
Great. Yeah, we work with a lot of large retailers, about $2.5 trillion of retail spend to the retailers we work with. And then we have about 500-600 large brands, small brands on the platform. What we help with is the exchange of data between retailers, large distributors, and also the large manufacturers and the large brands. So this has historically been done with a technology called EDI, which was invented 50 years ago, the year I was born, and there hasn't been a lot of innovation in kind of this connective fabric that ties all these important trading partners together. But through a platform like Crisp, they can exchange information much better, so everybody wins.
So what kind of data do you help these retailers? And again, as Jess mentioned, you've got the names like Amazon, BJ's, Aldi, Target, Whole Foods on this list, among many other big ones. What data do you provide them, and how do they leverage that data into action?
Yeah, it's particularly in that interface between the large retailers and the brands, and they typically have need for data around understanding how much is on the shelf, how much data is actually, or how much is actually sitting in the distribution center. What was the price of
How do you help them know that?
So we actually connect into a lot of these legacy systems that the large retailers have. So they have point point of sale systems, they have warehousing systems, they have logistical systems. So we help connect into these systems and bring all of that data into the cloud so that everybody can access this throughout a supply chain. So if I'm now on the brand side and I'm planning an advertising and marketing campaign, or I want to push a new product out, I understand how much I need to manufacture in order to meet the demand. Now they have much better view of everything that's happening across all of the different retailers.
How long does it take for them to access that type of data?
So it's been a big part of the reason we've been able to get so many on the platform. We invested a huge amount of capital into building this infrastructure, but once they come on the platform, it takes less than an hour. And there's a lot of changes in the industry now, and some of them are around advertising, right? So that the retailers are leveraging their data and their audience to drive more advertising revenue. They're also leveraging it in data sharing programs. So you have the large Amazons of the world, but you also have like a Walmart, for instance, that have incredible bottom line money now from advertising. And they also have a different program, which is called Luminate, where they actively share the data out with their suppliers. So we help in that interface. How do we get all of that data out of Walmart and Luminate and into all of the different systems that a brand have? They might have cloud systems, they have procurement systems, they have sales systems, they have all of that, and they want to have one view of data across all the different places that they need the data.
So that's kind of a solution for when there might be an undersupply of inventory for a product that's about to get a big marketing push. But what about excess inventory? We saw that coming up a lot during the earnings cycle last season, particularly with names like Target. How does your tool help these retailers with that?
Yes, so they calculate based upon sales velocity, so they understand how much each store is selling of this particular product, understand pricing, and then understand how much inventory actually sits out in the different stores and how much inventory sits in the distribution centers that support the stores. So with all of that kind of real-time information of consumer behavior, because we see every day kind of what's happening in the stores, now they have an ability to do much better forecasts of how much products they actually going to need. And before it was much more reactive because it was based upon a purchase order that would come out, but now actually the suppliers and the brands have an opportunity to kind of see what's going on and then produce the right thing, because it takes a while to produce these products. And that's kind of, I think what you're alluding to is you saw this huge build-up in inventory, because it takes, if you push a button today, it's going to take 3 months for this product to actually arrive. So being ahead of that is kind of what the tool helps with.
Talk to us about this startup credit crunch, because we're coming off a few months ago, obviously, all of the drama that went on with these regional banks, with SVB. I was curious, do you have exposure towards any sort of those banks that were in California, and how you view that whole situation?
Oh, that's a good, big shift over to something that makes me very stressed right now. I can bring up my SVB card that didn't work for a couple of days. But now I feel actually very good and comfortable around it with what the government did there to help the banks, as that prevented a big crisis, I think, for startups. I actually took the plastic of the televisions for SVB when they moved into New York 20 years ago, so I've been with them for a very long time, and kind of seeing how that changed so quickly. But now also there's a lot of other banks that are coming into the space and seeing that there's a great opportunity in this area. Plus SVB is actually continuing operations very well under new ownership.
Do you see any sort of red flags brewing up, kind of more broadly with startups at this point?
You know, I think, yes, I've been doing this for 25 years. It always goes in these huge waves of way too much money that comes into the space, and that drives valuations up and everything. And now the pendulum is certainly on the other side of that. And I like this period more because it actually weeds out a lot of the non-real type of startups. So I believe if you solve big problems for big companies and drive high ROI, now this is something that's very investable and exciting for investors to be a part of. So So I love both faces in a way, but I actually
Right.
like this face a little bit more than the frothy face.
Right. Well, it's great getting your perspective on all things when it comes to startups, but then also what your startup has been doing. So that's Ari Trosdale, founder and chief executive officer at Crisp, joining us in studio with Madison Mills and myself. So great getting your perspective on all of this.
Yeah, really interesting to think about how startup funding and credit tightening is kind of impacting what we're going to be seeing down the pipeline, and of course getting a check on the retail space as well, Jess. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Qualcomm, the largest maker of smartphone processors, gave a tepid revenue forecast for the current period, indicating that demand for mobile devices does remain weak even as the industry emerges from a glut. After ours, we do have Qualcomm shares trading lower by roughly 4%. PayPal said a key measure of profits sank in the second quarter as the company had to set aside more money to cover souring loans it has made to merchants. CVS Health beat estimates for second quarter profit and sales amid cost cuts. CVS shares did advance today by 3.3% on a down day for the rest of the market. And with more on CVS Health's quarter, here's Bloomberg's Denise Pellegrini.
Charlie, it's kind of a mixed picture at CVS with some signs of strength as the drugstore chain cuts staff to reduce costs and focuses on broadening its healthcare offerings. CVS also warning investors profit over the next 2 years will be hurt as medical expenses rise in its insurance unit, and the company cuts those costs. Adjusted earnings for the quarter, $2.21 a share. That beat the $2.10 average estimate of analysts surveyed by Bloomberg. Revenue rose 10% from a year ago, $88.9 billion. That also is a beat. CVS has been taking steps to move away from its retail roots and expand further into other dimensions of healthcare, in part with the recent acquisitions of home healthcare provider Signify Health and primary care company Oak Street Health Incorporated. And yesterday, the company said it would cut 5,000 jobs from its workforce. It's part of that initiative I mentioned to reprioritize investments around care delivery and technology. Charlie.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everyone, Madison Mills and Jess Metton joining you from the Bloomberg Interactive Brokers studio. We are in for Carol Masser and Tim Stenovic today. We've got a big hour left in our coverage for you today. We're going to talk to Bloomberg Business Week's editor Joel Weber about Amazon's grocery reboot. We're also going to talk about the American Family Farm System, Jess, and what's next for that space. But having said that, I do want to start off by getting a check on world and national news with Nancy Lyons in DC. Hey, Nance.
Hey, Madison. Former President Trump is scheduled to be arraigned tomorrow in Washington on charges related to his alleged efforts to overturn the results of the 2020 election. It's not clear if Trump or his attorneys will speak before or after the 4 p.m. hearing Eastern Time. Bloomberg Law host June Grasso says setting a court date for this case may be tough considering all of Trump's other legal cases.
Trump has trials. October 2nd of 2023 is the New York Attorney General's fraud trial. January 15th of 2024 is E. Jean Carroll's second defamation suit. March 25th of 2024 is the Manhattan criminal trial over the alleged hush payments. And then May 20th, 2024 is his handling of classified documents.
Bloomberg Law host June Grasso says it's possible this case may not be tried until after the election. Prosecutors put front and center in their indictment Trump's attempt to strong-arm then Vice President Mike Pence into refusing to certify the results of the election. Trump even derided Pence for being, quote, too honest. Today, Pence was asked to comment about the indictment.
Sadly, the president was surrounded by a group of crackpot lawyers that kept telling him what his itching ears wanted to hear. And while I made my case to him of what I understood my oath of the Constitution to require, the president ultimately, continued to demand that I choose him over the Constitution.
Pence says anyone who puts self over the Constitution should never be president of the United States. A jury